You don't want to get caught up in the daily ups and downs of the stock market and thinking that you're supposed to be adjusting to those things on a daily basis.
Scott Stone. So once again, I brought you in here today. I asked you to come in here. I think you have a very good, and I give you a lot of credit for it, too much at times, for being level-headed and helping clients and those of us on the team, right? Sometimes advisors get sucked into the volatility that's out there in the markets. And last year, 2023, we come off that year now, and that had not only just, downward spikes and valleys, I should say, in the market, then upward spikes. But we also had a huge spike in inflation going on during that time. So there was just a lot for investors to digest. And sometimes they get distracted and they get focused on, what do I do for the next week or the next couple of months? You always had a really good job, do a really good job of keeping people focused on the long-term picture. Like, what do you say to folks now as we're going into 2024? Who knows what brings it in the next 10 or 11 months here, but what do you think that you, words of advice, your sage wisdom? You have a perfect sweater. You look so smart in that sweater.
Thank you. It's very, very smart sweater.
I didn't mean to throw you off the game.
No, that's right.
I know comedy's not
I can rebound. I can rebound. So, so I think in our business as retirement income planners, primarily, we see a lot of people who are transitioning from a life of work into a life of retirement. And when they make that switch, you find a lot of times that they've, for 20, 30, 40 years of their work life, they've kind of been on autopilot in their 401ks.
Right.
They're not really paying much attention to it. They're in diversified portfolios. They're not watching the stock market go up and down every day. Maybe they check in on their accounts once a quarter. And then there's this switch. So they're leaving their employment. They're looking for a financial advisor to help them make that money last the rest of their lives. And they start paying attention to the details more, which is great in one way, and it's also harmful in other ways. And so you can get caught in the news cycle. And so when you look at particularly the financial news channels that are available, they get paid to get people to watch the TV program. And so their goal is not to necessarily keep people level-headed. It's to get people to watch, and alarmism is a very common tool to get people to watch. The red arrows and the fears of catastrophic losses and all of the potential negative outcomes that will happen in the coming year. And when they get a little bit of traction in a downward market, that gets more eyeballs on their TV shows, and their ratings go up and they make more money. So they love to stoke the fires of people worrying that they're going to lose all their money in the stock market.
Hyperbole. We always joke about, like, CNBC will put on, like, the biggest rise in the market this month since the previous month.
So
that's
the worst quarter since last quarter. They get really specific with their date ranges in there. So you don't want to follow the news cycle so closely. I, even as a financial advisor, have had to at times delete certain apps off my phone, stop watching certain television shows, and then just check in once a day, maybe a deeper dive once a week to really catch up on what's going on and making sure that you don't need to make any fundamental decisions to change the way you're investing. Mm-hmm. For the most part, for most of our investors, we employ diversified investment strategies that are all weather, and we make tweaks to them as the market would warrant. But for the most part, most of that portfolio is going to be set up to take you from the beginning of your retirement to the end with some tweaking, maybe getting a little more conservative as you go forward. Maybe we tilt a little bit to one asset category or another, depending on how interest rates are fluctuating. But you don't want to get caught up in the daily ups and downs of the stock market and thinking that you're supposed to be adjusting to those things on a daily basis. The shorter time frame that you're looking at for an investment, the less accurate your judgment calls are going to be. You're more or less throwing darts at a dartboard to figure out whether Apple stock is going to go up tomorrow. there's some chance that it will and some chance that it won't. And so you make a decision. When you start looking at, the management teams of these companies and the industries that they're in and the longevity of those industries and whether or not they're in peril, and you start looking at making a 10-year investment in a company, you can have a little bit more confidence that the long-term investment in that company is going to pay off. Maybe it won't be the best performing company, but it's going to be a good performing company. And then you add in diversification. So you don't just invest in one company. In our investor portfolios, you're going to have thousands of companies, exposure to thousands of companies from across the world. And then you're going to have fixed income, you're going to have some real estate and other types of investments in those portfolios to try to iron out some of those ups and downs, some of those undulations. Because one of the most important things investors have to remember is that staying invested is extremely important. Mm-hmm. What we find the most devastating to an individual's portfolio when investing is when they ride the wave all the way down and now they reach a panic point because they've lost 25, 30% of their portfolio and they say, I can't take it anymore. And they pull the trigger and get out of the stock market and go into all cash. Yep. And then the market goes back up 30%. And then they get confident up here at the top. They're like, oh, well, the market seems fine now. I guess we're safe. They get back in and they've missed a 30% rise. And then they are in for the ride back down. So you want to be consistent. Historically, in the past decade or so, we haven't really had an option for staying in a super conservative portfolio, like a total fixed income portfolio, CDs, things like that. But now, as interest rates have come up, at least in the short term, there's a lot of different methods that we can get a decent return on a fixed income portfolio, like our Power Savings platform, where we invest your money all in money market funds and CDs from various banks to maximize your FDIC insurance coverage. And those portfolios are great, at least in this time frame, because you can get sometimes 4.5% return net of all fees on those investments, and that will generally keep up and surpass inflation, except in short periods of time, like we just experienced in the past year or two. So those are things that you want to keep an eye on for retirement. Is not buying into the hysteria of particularly the financial news channels and news apps, and maintaining a long-term investment horizon, knowing that the longer you stretch out that time horizon in a diversified portfolio, the more likely you are to win. Yes, to all that. Yes, all that.
I guess I would say, in addition to what you just talked about, is the word emotion. Mm-hmm. Yeah, in our, I think collectively we have like 50 years of experience doing this, right?
Lot, yeah.
But I don't recall any times where a client or even an advisor, but a client made an emotional decision that probably turned out really well or in their favor. Right?
Yeah.
And so that works both with, I guess I would say there's always, you hear the stories about your friends or your relatives and they did this or this, and that's exciting, but they don't tell you about the losses. They only tell you at the Thanksgiving dinner, they tell you about the one stock they had, not the 8 that went down.
Yeah.
But when it comes to emotion, when you talk about that, I always use that analogy of somebody looking at their amusement park and you look at the ride and you see the roller coaster.
Right.
You should, either an investor or your advisor should be keeping you educated on the kind of volatility you can expect for the portfolio that you're matched up with.
That's a great point.
If you don't think you can stomach that kind of volatility, then you need to look at something more conservative. And we joke in our office, or at least I always did, that people, when I first started in this career, people were fine with risk until there was risk, until they saw losses and they say, wait, what's this? In 1998, everything was just going up.
Right.
And so everybody was, put me as risky as you want. And then when things turn the other way, they go, oh, wait a minute, I didn't expect it to go down. Well, that's what the risk means. You can lose. So just when I say strip the emotion out of it, don't get into the headlines like you're talking about, but also, it's kind of very similar to when you lose a spouse. And someone comes to us and they say, hey, can you help me sort out? I'm inheriting money, or I'm taking over from my spouse who's gone. Usually that's really a time we tell them, don't make any big changes, any permanent decisions. Just kind of let the emotions die down and let time pass a little bit. And I think that people sometimes look at advisors and if your advisor says, no, just stay right where you are, it feels like the advisor's not trying. Right. They want you almost to do something, right? But sometimes you really genuinely feel as the leader on that portfolio, it's in your best interest, ours collectively, for you just to hold tight.
Do something. Yeah.
Last quarter in 2023 is a great example. Folks saw the downswing. You hold those positions as much as you can, maybe do some fine tuning, as you're saying, but then it came back.
Yeah.
So there's a lot of science and data driving our decisions and telling them to stay put.
You don't want to act for the sake of acting. And so I think a lot of times clients call up and they're like, what are we doing? They want to see some sort of change, some sort of motion, some sort of action. And oftentimes that can just dig you deeper into that hole by making the wrong changes at the wrong time.
Right.
So some of the ways that we offset that, we have what we call an investment policy statement questionnaire. And so it's a 7-question questionnaire that helps you understand how well you're going to sleep at night, essentially, with your investments going up and down. And it shows you more or less what you can kind of expect in the different types of portfolios. You might gain 25%, you might lose 25%. We try to put it in dollar terms. So if you start with $100,000 and it goes down to $75,000, are you in a flat out panic, or are you thinking, all right, I'm okay with that, it'll come back? And so we can kind of match you with the portfolio that allows you to stay invested. As we said before, you want to stay consistently invested for at least a 15-year period of time, preferably when you're dealing with your investment portfolios. And so we help people match up with the portfolio that they'll feel comfortable staying invested in for that period of time without hitting the panic button. And the second is that we have our Flex program. So you don't want action just for the sake of action, but if it's very logical and mathematically based, then you can implement certain strategies that can help limit some of the downside losses in a bear market. And so we do that with our Flex program. That's optional to add to our investment management portfolios like Diversidex and Essential. You can add Flex, and that will take about 25%. It differs depending on the market environment that we find ourselves in, and we make adjustments to it. But about 25% of your equity portfolio, and we'll just put that into a money market account temporarily. That money market account is very safe and won't fluctuate very much. And that allows the stock market to go up and down and do whatever it will do. And then when volatility subsides, meaning the waves in the stock market, when those waves calm down a little bit more, we take that money and put it back into the market. Typically, the market does better in calmer seas than it does in highly volatile seas. And so theoretically, if you take some of your chips off the table when the waves get rough, and then put it back in when the ocean calms a little bit, to really push this metaphor, then you can, in many cases, get the same or similar return that you could get by leaving your money in there the whole time and riding the waves all the way up and down. Instead, we kind of get you out and get you back in at a time when it allows you to level out your undulations and your
hopefully
portfolio
a smoother
balance.
ride, right?
Yeah, smoother ride.
I mean, it's not really meant to get a better return. It's meant for a smoother ride, keep you comfortable enough to stay where you need to be invested.
Correct. In some environments, it probably would produce a better return. Others, it might produce a slightly less return depending on how the market functions. But the idea is to preserve your sanity during those times of major volatility.
Yeah, I probably shouldn't laugh, but that's actually a legit thing. And I love the Flex program in our office because it's no additional fee, and it's something that people can just add, or they, if they start to feel more comfortable, they get more experience with being invested. They say, maybe I don't need that anymore, or your advisor might recommend that you put that on or off. So that's a nice thing. So you got the Flex option. We've got for folks who are still really conservative. You mentioned power savings, and then we have a whole bunch of other types of portfolios that are a little bit more out there. I don't mean out there, but like that next level. Usually looking to get the 5 to 10% long-term returns on their accounts, which is typically what they're needing when they're in their retirement. So we always talk about the risk return trade-off, but you can think of it more as kind of
return versus uncertainty. So the more uncertainty there is in a portfolio, typically the more you get rewarded for accepting that uncertainty. So if you can not be sure whether you're going to have $70,000 next year or $120,000, that gives you kind of an uncertainty premium, and that would be an aggressive portfolio. And so in an aggressive portfolio, you're probably, historically speaking, you'll generally receive a larger return over time. But there's going to be times when you start with $100,000 and you look at your statement at the end of the year and it says $60,000, and you're going to be very uncomfortable.
That's a big number.
Yeah, but then it'll come back over the next 3 years, and then it'll be $130,000, and you'll be happy you were in there. But obviously, you're going to experience some pain from time to time. You don't have to go that aggressive route, though. So Bob was talking about Power Savings being one of our more conservative platforms, but we also then take our diversified portfolios and we segment them based on risk into conservative, balanced, growth, and aggressive. And as you go up that chart, you'll receive more volatility. And historically speaking, you generally get rewarded with more return for taking on that additional uncertainty and volatility.
Yeah. You're doing a lot of hand gestures. I feel like you're getting a workout here.
Yeah. If I had maracas, this would be more entertaining.
This is great. So basically, like, to boil it down to, for you, what you're typically telling people, what we all are saying is like, stay focused on the horizon, not the news of the day, not the headlines and all the clickbaits and all that stuff you're seeing. Get in a portfolio that you can feel comfortable in, but also meets the needs. And if you're still an ultra conservative person, you don't like any volatility, your expenses need to match up to what you have saved up. You can't spend a ton of money with a certain amount of savings and want to spend 10% a year and only be willing to get 3% worth of return because you don't want any risk.
We help people visualize that as well with our future you analysis, which kind of looks into the future based on how the different markets we invest in work. And it tries to predict with a reasonable degree of accuracy what type of return you could expect to experience in the future. There's always going to be some room for error there, but it gives you an idea of what type of lifestyle you could expect based on the type of investments and the amounts of those investments you have now. And so, as you point out, if you say, I can't take any volatility, then you lose out on that uncertainty premium that we can get from being in a diversified portfolio. So you're going to be in an all fixed income portfolio. And depending on the year, historically over the past decade or so, that's been very, very little return. Now it's a reasonable amount of return, but you're still losing out on a lot of potential long-term return from going into that diversified portfolio. And so you would have to then adjust your spending expectations because you're not going to have the income going forward if you don't accept those uncertainty premiums.
That's perfect. I mean, I think that's probably good for this particular video. We covered a lot right there. Yeah. And I guess I would ask our viewers if you think, we'd love for you to weigh in the comments below the video. Does that sweater make him smart, or is it what he says that makes him smart?
I was going to have a smart pair of glasses I was going to put on too, but
we've been doing this a long time together. So if you can't bust on each other, you can't have fun, then why go to work? But
true.
So that's great. As always, our clients can talk to our advisors back and forth and make sure they're in the right portfolio. If you're not sure where you are, by all means, give us a shout. It won't hurt to have a second opinion. We love talking about this stuff all the time. Thank you very much. We're on to 2024. Let's hope it's a good one.
Woo. All right.